And hello again. Welcome to the Marc Oslar Retirement Experience. My name is Randy Cook. I'm here each week with Mark as we sit down and talk through some of the issues of retirement. Every now and then, we're going through financial headlines and trying to make sense of all that stuff. But really what it comes down to is this. You are wondering and worried about what's going to happen when you walk away from your employer paycheck. I mean, it's a scary thing. This is life beyond the 401k. And what we're trying to do here is to say, hey, there's help out there. And we would love to have the opportunity to talk through it with you. And if it all meshes up, we would love to be able to help as well. Mark, how are you doing today?
I'm great, Randy. I hope you're having a good day.
Yep. We're into October already. Holy cow. Here we are.
Wow.
Halloween is just around the corner. I told you. I said last week, we did a segment about getting that end of the year meeting. I said it's going to start flying by, and here we go. We're on the cruise pathway to Halloween, and then after that, it's just over with, isn't it?
Oh, shoot, Randy. I mean, my gosh, I felt like we had our kickoff year event for 2025 just the other day. I mean, it just happened so fast. I've got 4 daughters, right?
Yeah.
So I've got 2 older daughters, they're 24 and 20. 24-year-old actually works with us with the business. And then I've got 2 younger ones that are 12 and 8. And 12 and 8-year-old, of course, we're going to do a little trick-or-treating with them and everything. So they keep me young. They make me feel old, but they keep me young.
Just a little hi to Stella out there. I know she's one of our biggest fans. Okay.
Absolutely. That's the 8-year-old.
All right. So when we talk about the issues of retirement, one of the first ones is how am I going to get paid? How do I make sure that I've got money to do the stuff that I want to do in retirement? And Kiplinger had an interesting article just recently, and people are asking questions about retirement. And one of the questions was, if the market is down or the market is flat, should I back off on my withdrawals? Mark, what are your thoughts on that one?
There are times where people are taking withdrawals from their let's just say their brokerage accounts. Mm-hmm. And let's say the returns are flat or they're going down. We know that if the money's going down, if the market's going down and you're taking withdrawals, we kind of joke about it. We call it the double whammy, mm-hmm. right? Because you're getting hit while you're taking the withdrawals. It does have an effect. We call these the sequence of numbers. And on these sequence of numbers that we go over, we can talk about how there's a huge difference between if you're taking money out of a plan that's going up and down, if you just change certain numbers and figures. So you can have the same returns, right? And they could be in different years. And if you're not taking withdrawals, you have the same return at the end of the day, at the end of let's just say 10 years. But let's just take another 10-year period, and you're taking withdrawals, and you change the returns in the given years, there could be a drastic difference. And that's what's important to understand. So the question is, can you still take withdrawals in those situations? Of course you can. The question is whether or not it's suitable or makes sense for you to do something like that. I can tell you that there are certain circumstances where we have some structured notes that if things are flat or a little negative, that it doesn't hurt, it still pays. It's called an income note. That can happen, and you can do that because there are barriers, but that's a discussion for another day.
Well, when I think about my working years, my paycheck, I'm going to go to work, and if it's raining, if it's storming, if it's summer, winter, spring, whatever season, the money's still coming in. And I think that, the only time that the money doesn't come in is if I lose my job. Okay, that's when the money stops. Well, that's not kind of what we're talking about here. In some ways, I guess we are, because we're not working anymore in our retirement years. But I think what people are wondering about is I would like to have some kind of a strategy where the market goes up, the market goes down, the economy does whatever it's doing politically, we're doing whatever we're going to do. I don't care about all that. I want to make sure that I'm getting paid, that I've got my $6,000 or my $7,000 or my $8,000 a month in retirement. That's what I'm most concerned about, is that my paycheck continues. And I think to this person who says, if I back down on my withdrawals when the market is bad, that's kind of making the market in charge of your retirement, isn't it?
It is. And there's so many different ways that you can look at this. And do you really want to deal with that in retirement? Do you want to deal with always being in the ups and the downs with 100% of your investable assets directly in the market? You have to ask yourself that question. Can I put my head on the pillow comfortably at night? And is that something that I really want to do? You don't have to. There are different phases in life. The early on phase is accumulation. and maybe even in your 50s, it's accumulation. But when you get closer to retirement, it's very similar to, we joke about this, the target funds or the life cycle funds and 401k plans. But what happens is when you get closer to the target date, it gets more conservative in the portfolio, picks more fixed things like bonds, right? So that comes up. That also happens in 529 plans when you're investing with regards to putting away money for college for a kid or a grandkid, right? But here's the thing. The question is, are you going to be as conservative as you want to be in retirement with regards to how you take your income? Because income is important. We focus on several things here. We focus on, we don't want to run out of money, right? So we talk about income, we talk about taxes, we talk about inflation, and then of course we get into estate planning and things like that. We involve the attorneys, the CPAs or accountants as needed, right? But the most important thing to understand here is, what level of risk or how much risk do you want to take in retirement? We can talk about the balance of that, and we can also discuss, do you want to look at a lifetime income rider? That's another discussion as well.
Well, we would love to have the discussion with you and sit down and talk about your feelings about risk and the markets and Social Security and all that goes along with this whole idea of retirement. The whole thing, though, is let the world do what it's going to do. I want to make sure that paycheck is still coming in. Social Security, and then what? Let's give you the then what and go through that particular conversation. Here's our number. Here's our website. We do a no cost, no obligation conversation. Let's see if your needs and your feeling about us, and we would make a good team together to help you with your retirement planning. MoreToRetire.com is our website. That's pretty easy. Just spell it all out. MoreToRetire.com. Bottom of the page, there's a place for you to put a little information in there, and Mark and the team will reach out to you, and we'll start the conversation. Or you can just do this. Call us at 984-300-1984. 984-300-1984. Let's get going from there. All right, the headline reads this: I'm 80 and my RMD is $300,000. What the heck am I supposed to do about all these taxes? That was in Market Watch, and this is another example of why we talk about people going into retirement and their main asset is their 401k. It used to be that it was our parents' house. That was their biggest asset. Now the biggest asset is the 401k, and it's got a tax liability with it. So if he has an RMD of $300,000, I think, if my math is right, that means this guy has saved like $6 million. So I can't feel too bad for him. He's done a good job. But still, that's a huge bill. He obviously didn't listen to you when we were talking about conversions. This is the poster boy for this, isn't it?
Boy, do I feel bad for this guy. It must be awful. Randy, oh no, he's got $300,000 a year coming to him. It's just terrible, right? No, truth. I mean, let's just be honest. I mean, this is not typical, but yeah, you've got clients like this. I do have a few clients like that, we had discussed a few years before, do we want to do some conversions, some Roth conversions, things like that. Here's the thing. Let's say you are going to have required minimum distributions at age 73. Let's just say that's you.
Okay.
Well, let's also say there's also people at 75, but we're going to talk and focus on the people at 73. So that's in the near, right? That's the folks that were born, before 1960. So anybody before 1960 in terms of birth have to take a required minimum distribution at 73. It's a little less than 4% where it starts out. And then eventually it just ticks up a little bit each year because it's a divisor. So what happens is the factoring table goes down, which means the amount you have to take out goes up a little bit each year. As that occurs and as that happens, we discuss, do we want to do Roth conversions, right, from your IRAs? And we have this discussion of how much. And we start looking at tax limits. We talk to your tax professionals, and we discover and decide whether it makes sense for you to do that. In addition to that, a lot of folks don't realize this, but because of the different provisions that were made in Secure Act 2.0, you can continue to do Roth conversions even after required minimum distribution age. You just have to take your required minimum distribution before you do that conversion in that given year. Most folks that look at this strategy realize that later on in life, it can be more advantageous for yourself and your family. Not always, but if you look at it from a perspective of what's going to look like at the end of the tunnel or at the end of the day. We're talking about years in advance. If you can see the big picture, it's a good conversation for us to have.
So what do you find people, I imagine it's just all over the map, but say somebody wants to retire at, say, 67, and they're probably going to do their RMDs at age 75. Person who's, born after 1960. They've got some time. They've got like 8 years there to do that. Does it make sense? Do you find people that will do some small conversions before their retirement date while they're still working and working all that tax magic? Or do they say, I'm going to wait till I stop working where my income goes down, then I'll do the conversions? Where do people usually fall on that one?
Both. I see both scenarios. So I've seen it where folks are saying, you know what, let's get started now. Let's start doing some Roth conversions. And then I have other folks that say, I want to wait until I don't have that earned income before we start doing that. And I get it. We can work with both. I think the earlier you look at it, the better for yourself and maybe for your family as well. Realize that when you do you have to realize that when you do a Roth conversion from an IRA to a Roth IRA, that it is 5 years in deferral, meaning that after 5 years of that particular conversion, then the full amount, including the returns, become tax-free.
Okay.
Now, the principal amount that's put over there is already going to be tax-free because you paid taxes on it when you converted it, right? But it's the growth part of it that's not tax-free until the 5 years pass on.
When people do these conversions, do they take the money out of their 401k to convert, and then they also pay the taxes with the 401k? Or is it better probably to take it out of another account, because that's kind of taking away from your future if you do it the other way, isn't it?
100%. And my gosh, if you're separated if let's just say you're under 59 and a half, if you're separated from service, whether you were retired or whether you were laid off, we should look at your 401k and look at rolling it to an IRA, whether it's in the market or in something of a preservation vehicle like an annuity. It just depends on what's the best fit for you percentage-wise, how you allocate, those types of things. That all comes down to the planning aspects, but we certainly should look at it. And then if you're 59 and a half or older, we can roll any portion of your 401k and you still keep it open and contribute to it. That's the case 95% of the time. Again, if you want to start somewhere with me, this is a great place to start.
I heard somebody the other day say, if you're in a 401k, it's kind of like being on a cruise ship. You're in that big boat and you've got no say on where that boat's going. You're not steering the boat, and you're in there with hundreds and thousands of other people. Those are the employees of the company. But when you get into retirement, it's time to put you in your own boat. It's time to make you the captain. It's time to give you those decisions of where you want that boat to go. Let's give you that power in your retirement planning. Here's our number. Here's our website, moretoretire.com. That's moretoretire.com. There's a place down at the bottom of the page for put a little information in there. Maybe you just say, hey, I want to talk about my 401k. I want to talk about Social Security, whatever that is. Let's get that out on the table, get those questions answered. 984-300-1984 is the number. 984-300-1984. Let's get a date on a calendar and talk about your retirement today. So when interest rates were going up, we were told that billions of dollars went into CDs and money markets. That totally makes sense. As millions of boomers are looking to retire, they want a paycheck. So we found that the amount of annuities that have been sold are hitting record numbers all the time. Well, today in the Wall Street Journal, there's an article about billions of dollars that are now pouring into dividend-paying stocks. All right, I don't know. Mark, tell me why. What is it that is now is really attractive about dividend-paying stocks? Are you using them? And what's the big deal there?
We have two different proprietary platforms under Market Guard. Market Guard is who we use as a group of chartered financial analysts that really put together some good information, and it's a scientific method, a way of investing. And I'm one of only 300 advisors that has access to the Market Guard platform. There are two different particular pure equity models. One is their regular opportunity model, and the other one is their opportunity dividend model. If I was to use one or the other, I would say I use the opportunity model a lot more than the dividend model. Mm-hmm. And the reason why is because I believe I have a different philosophy with how I go about things for my clients. So let's just say, for example, of somebody that looking for income. Okay. If somebody's looking for income, we can look at it from several different angles. We could look at a fixed index annuity that has a lifetime income rider built in, and we could have some type of lifetime income rider that makes payments to us. Some of them could be increasing as well, depending on what is selected. The increasing portion of it would be for us being able to maintain inflation, right? Or at least deal with inflation in the future, because you could see inflation be flat for years and then all of a sudden hit us hard. And we've noticed that the last few years, right? So interest rates are popping up, and we're recognizing now that since interest rates probably have peaked now, and it looks like maybe a potential other cuts are coming, we discuss how many different people are getting into multi-year guarantee annuities for us. There's a lot of folks doing it. I mean, there's 3 or 5 year rates generally, for the most part, are outperforming CDs. And so it's a great time to get in because you can get that. And the difference between an annuity and a CD is simply that you're not going to be paying the taxes right now on it. It's tax deferred. And so if it's tax deferred, it can also grow compound. So these are two avenues I generally look at before dividend paying stocks. The other third avenue I might look before paying dividend paying stocks are when we look at structured notes. Now, structured notes do a couple different things. There are growth notes and there are income notes. On the income notes, they have particular barriers set up, so I know that if it stays within certain parameters, that the bank will pay that certain return for that person, and I feel pretty comfortable with that look at things. So I look at those three things before I look at a dividend-paying stock, but dividend-paying stocks became attractive again, and if the market pulls back a bit because the market seems like it's at its peak, that's why people are starting to look at dividend-paying stocks, because they're thinking, well, at least I'm going to get this dividend off this stock, and I wouldn't have to worry as much necessarily about the wobble of the market, right? Would you agree with that?
Yeah, I think you buy a stock, just a straight stock, you buy a share of NVIDIA, and then in order to get paid on that, you got to sell it. You got to sell the stock to get paid. And that's not really what we want to do a lot in retirement. But if you buy a dividend-paying stock, it's going to throw off income. Now, the problem that I see with that is the inconsistency, perhaps. I mean, if you buy some stock and it says we're going to give you a 3% dividend or a 4% dividend, that's not locked in for the rest of your life. They can change that idea according to what the market is doing, according to their profit reports and things like that. So you can't really depend on that as you could with, say, for instance, an annuity payment. That's
right, because you look at something called earnings, right? And if they feel like their earnings don't look so attractive, they might not pay that dividend, right? They have that choice to be able to do that. So, for example, when you're looking at whole life insurance, there's dividend-paying ones, the mutual companies. Guess what? They might have been paying it for 50 straight years, and that's on the non-guaranteed portion, and you feel pretty good about it, but it's still not guaranteed, right?
Right.
And that's why people have that issue. Well, structured notes aren't really either. And that G word, we don't like to use the word guaranteed unless it's in the titling. So if you're talking about a lifetime income rider, they use that word, okay? Now, that is an insurance-based product. But the structured notes, no, you don't have that preservation, okay?
Yep.
And then when we talk about the multi-year guarantee annuity, yeah, it's in the contract, so they're going to pay that rate of return. So you're getting that, whether you defer it and compound it or whether you take the interest.
Yeah, I think that that is all going to be up to the individual, because you're going to look at all of these options that are out there on the table and say, well, this one goes up, this one goes down. And you might look at them and go, I'm done with up and down. I don't want up and down in my retirement. Just give me that guarantee. Okay, that brings us to another discussion. So let's talk through your thoughts, your concerns, your questions, where you want to be. That's really what this is all about. Introduce you to Mark. Let's have the conversation. MoreToRetire.com is our website. MoreToRetire.com. You can start there. Go down to the bottom of the page. There's a place for you to put some information in there. Mark on the team will reach out to you. Or you can reach out to us right now at 984-300-1984. Well, we are coming up on an interesting date, October the 15th. Might not mean anything to you, but if you're one of the many, 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 many people that turned 65 this year, this becomes a new date that you're going to be looking at every year. This is when the Medicare window opens. What does that mean? Well, from October the 15th to December the 7th every year, you can make a new Medicare decision on supplements or an Advantage plan or anything like that. So you might receive something in the mail called an ANOC, which is an annual notice of change. And that's telling you, okay, next year, your current plan, this is how much it's going to cost. And prices and premiums are going up, as we would expect. So what do we need to know about this, Mark? Because, like I say, there's so many people turning 65 this year that this is their first go-around with this. Or maybe you're only into it a year, and this is your second go-around with this, and now you've got a new medication or something like that, and it's not covered. What do we need to know about the Medicare window?
This is great, Randy. So we have some professionals that we work directly with. I am licensed with Medicare Supplement, long-term care, things like that. Mm-hmm. But a lot of times I bring out some guys that do it on a regular basis. And the reason why we do that is because they can focus on that. And I focus on some other things, but we work together, right? So we want to make sure that we do some good work for you. I understand this stuff very well. It's important because you want to understand if you need to make adjustments or changes without having to answer health questions, right? So that's an important thing that folks want to be able to do. When you have open enrollment, you don't have to worry about that as much, right? So we talk about being able to discuss what helps your bottom line. So the question here is, in terms of Medicare Supplement, what can you afford on a monthly basis? Because it looks like premiums are probably going to be going up. Mm-hmm. We've gone through inflation. We're feeling the effects. Claims can also do that as well, but it looks like a lot of premiums are going to be going up, and we need to discuss, we need to cut back. This is no different from people that have had long-term care insurance for years. A lot of times you'll see, after 3 years, another premium increase, and they send you something in the mail, but they give you these options of, well, you could do this, this, and this, get rid of a few benefits, and we'll keep the premiums the same. Mm-hmm. Or we'll cancel the inflation rider. So with regards to Medicare Supplement, and you're talking about parts C and D, and just discussing how that's going to hurt your bottom line or help your bottom line, we also want to talk about how much you're taking in medication, because we can figure this stuff out together. We can discuss the premiums versus the cost of the medication. It might come out where it's better that you don't do a certain plan just based on the bottom line. You are taking a little bit of a risk there because of the what ifs, right? Mm-hmm. And so those are the things that we discuss in general. And we have this conversation because we want to make sure that we're assisting you in making the best and highest possible decision for you with regards to your future. So I would say coming up October 15th, take this very serious.
Yeah, as you go through retirement, obviously things are going to change. And something that might change with you is where you are with your health. Maybe you get a diabetes diagnosis, and all of a sudden that becomes a major factor in your life now. That means different medications. That means all sorts of different things. And what if the current plan that you have right now isn't really geared in that direction, but there's another one that is? See, this is the time of year when we discuss that. Let's have that discussion. Here's our number. Here's our website, moretoretire.com. Moretoretire.com. Down at the bottom of the page, a place for you to put a little information in there. Maybe you just write in there, I want to know more about Medicare, and I've got a question about that. Okay, let's get it answered for you. 984-300-1984 is our number. 984-300-1984. Give Mark a call, and we'll start the conversation from there. We're going to take a break, and when we come back, the article started with, I spend 5 hours a day on my portfolio. That guy sits down in front of you, Mark. What do you say? We'll talk through that one coming up next on the Marc Oslar Retirement Experience.
A simple piece of paper. It's something we use every day. For the most part, it does what it's designed to do. It sits there flat on your desk as a placeholder for information. But with a couple strategic folds, suddenly your flat piece of paper becomes an airplane and flies across the room. Your 401k is kind of like that flat piece of paper. It just sits there as a placeholder for your money. Marc Oslar can show you those strategic moves to take your 401k from just sitting there to creating the income you need for retirement. Call today for a free no-obligation meeting. 984-300-1984. That's 984-300-1984. or online at moretoretire.com.
And welcome back to the Marc Oslar Retirement Experience. Online, you can find us at moretoretire.com. If you're in the car, you're listening to the show, you like what you hear, you want to hear a little bit more, that's okay. We have a podcast as well. All you have to do is go to iTunes or Spotify, look up the Marc Oslar Retirement Experience, and full shows will be there for you, so you can kind of scroll through that on your own time. All right, if you are a DIYer, I get it, you Mr. Spreadsheet guy, I love you. But somebody wrote into Market Watch and they said this: I spend 5 hours a day on my portfolio. Now, I'm just going to stop right there. I'm not even going to get into his questions. Somebody walks into your office, sits down. Hi, Mark. How you doing? I spend 5 hours a day doing this. What is your initial reaction? What is your read on that person? And how can we get them out of their chains, so to speak?
Well, I've met folks like this that come in and they don't often become a client just simply because they just feel this clutch of having to be in control and in charge of it, so much so that they can't let go.
Yeah.
And some of these folks that are doing this, they're, I wouldn't say day trading, but almost, let's just say weekly trading. And they might also be trading options as well. I won't get into that, but I'll say that, folks, if you're in retirement and you have better things to do, you can leave it to the professionals to have a conversation and talk to you about this. I mean, this is what we dedicate our lives to, right? So for me, I don't try to be the professional in every area of my life. I look to the professionals, but you want to pick the right ones. And, just having a conversation with me, let me, run a report for you, have a conversation about where you want to go, where you're at right now. Do you have 10 years left to retire? Are you in retirement? Are you spending 5 hours a day on your portfolio? I mean, that's a telling subject right there. But I'll be honest with you, Rand. I don't know how you go about that and then feel like you could retire.
I know one guy in my life who can do this, and I don't think he spends 5 hours a day on his portfolio for sure, but he loves to keep track of things and to buy things and to sell things. He's very, very conservative, and he's extremely smart, and he can do it. And there's information out there to do it. But do you really want to be a financial advisor and a broker and a CFP and all of that in your retirement, trying to do that yourself? I mean, I think of myself, seeing a drip underneath my sink, and I go, I could fix that. So I go under there and I tighten something up, or I put something in there, or a super glue or something, and it's probably going to fix for a little while, but sooner or later, maybe not. And then I got a real mess on my hands. That's just water underneath my sink. Messing up your retirement or making a mistake there, that has more consequences. And I just, that seems to me to be kind of a high risk situation, Mark.
It definitely reflects a lot of concern for me. So if you're sitting there and you're spending 5 hours a day on managing your portfolio, the question is why? And do you have the right mindset in retirement? Is this something you're going to be able to live with? Because I got news for you. You might be doing it now at 65 or 70, but you hit 80 years old and it's not going to be the same.
Yeah.
Even mentally, you can challenge yourself mentally in your 80s, but it's not going to be the same. The question is, when do you want to involve someone? And if you're not going to involve, a financial advisor, at least involve some family members that you have trust with, that you can discuss how you go about doing things. If you really want to do it yourself, I get it. That's fine. But I'll tell you one thing that you don't have that we have. We have some things, some customized portfolios and things that we do that you don't have at home. And we can show you how we go about doing things, because the way we want to invest for you is we want to invest for you in a way that meets your needs, your goals, and your desires in life. We don't want to do anything different than what you're doing for yourself right now. But we will make some healthy suggestions as well along the way, because you're going to get a lot more from us than just investing your money. When we get together, we put together plans over the years to make sure that you're doing everything to the highest degree and level that you need to do it to. So when we're talking about just investments, we're talking about income, We're talking about tax professionals and attorneys for all the things we need with regards to taxes, inflation, and estate planning. We have discussions about longevity. We talk about health. We talk about what your needs might be in retirement. We talk about long-term care. We discuss things to do with your children, your grandchildren. We want to understand as much as we possibly can so we can be with you and help you and navigate this with you in retirement. That's what we want to be for you.
And you talk about family members too. I mean, let's just say that this guy is spending 5 hours a day on the portfolio and he just loves it. He lives it. This is kind of his hobby. Okay, that's fine. What happens when you're not here? What if you pass? Are you going to throw 5 hours a day onto your wife and she doesn't know what's going on? Because obviously nobody can know exactly what's going on if you're doing this for 5 hours a day. Mark, I think that's as much a reason as any. If you are the DIY guy like this, do this for your family, do this for your wife, do this for everybody else. I mean, you got to be able to turn this over at some point. And I could tell you my wife wouldn't want to do this. I mean, that's a really good reason to sit down with you.
100%. That's a task that most people don't want to have happen. Mm-hmm. And I've had some clients that were so involved in the things that we would work on together, but wouldn't involve the spouse a lot. And I would always encourage and suggest to involve the spouse. And then usually at some point when you hit a certain age, that you might involve a kid or two or somebody that you really trust or care about, or an attorney that you feel like needs to know some stuff. Fantastic. If you don't have attorneys, we've got great ones we can refer to you. But these conversations need to happen because you're not going to be here forever. Your mind might not be here forever. And I've had clients pass away in these types of situations, and it does not make it easier for the family. So my suggestion is have these conversations now. Why not come in for a visit? I promise you one thing. I promise you that my objective is not to make you the most money possible. I'm not going to try and make you the most money possible. And you're going to say, whoa, well, you're not selling yourself, are you? No. I'm not. What I care about is making sure we meet your needs and goals, and we meet your needs and desires for retirement, for you, your family, your extended family. You can still be a DIY guy, but it's okay to also let the hands off a bit and allow your professionals to work with you. And if it's not me, I'm glad. There's tons of great professionals out there.
You're listening to the Marc Oslar Retirement Experience. We talk through retirement here all the time, and there's a lot of different aspects to it. And I know every one of you out there is going to be a little bit different. Well, your retirement plan needs to be a little bit different too. Maybe you're a person who likes to have their hands in the pie a little bit. That's okay. That's okay. But let's make sure that we're taking care of your family as well. And here's our number and here's our website to start that conversation. MoreToRetire.com. MoreToRetire.com or 984-300-1984. 984-300-1984. Well, on any day, Mark, you and I could be doing the show any day of the week, any day of the year, and I could find something in the news where one guy is saying the market is going to boom. We're at the beginning of a brand new bull market. Or I can find somebody that will also say we are on the verge of a cliff. We are on the verge of a collapse, a crash in the stock market. You can find that at any time. So as I'm looking through the financial news, I see some people who are kind of consistent. Ray Dalio is a guy that you might see on the financial networks. You'll certainly see in the financial news. He's the CEO of Bridgewater, and they handle a lot of people's money, $90 billion. Well, I saw an article with him in it, and he quoted an ancient Chinese proverb, and it says, "A smart rabbit has 3 holes." And I thought about that for a second. I thought, okay, I get it. If the trouble hits, the rabbit's got to have some options. It's got to have 3 different options to get away. Well, financially speaking, if the you-know-what hits the fan, we got to have some options too. And I wanted to ask you, let's make everybody a smart rabbit here. What are the options that you would use to kind of get out of the way of a market that's going down, kind of an exit ramp, so to speak, in order to help preserve people's money?
Well, I like that. The you-know-what that hits the fan. Right? Should it? No, we don't want it to, okay? Holes, and we use the word buckets. Mm-hmm. And yeah, people think, oh, well, bucket's different than a hole. It is, because the way I look at it is it's not an exit strategy. It's just strategizing and effectively planning and spreading things out. So, Randy, if somebody came to me and they had like $600,000 and I'm like, okay, let's put $550,000 into an annuity, would that give you a little bit of alarm?
Totally.
Absolutely. Why would I suggest that? I can't do that. It doesn't make sense for the person. What we want to know is we want to know a little bit more about you. And we want to identify certain things. Do you have 5 years before retirement, 10 years before retirement? Are you in retirement? And how are you allocated now? And we want to answer questions for you based on the questions that we ask you, and we hear your answers, and then we counter, because we want to get in your mindset to understand what you want to accomplish. And then whatever we suggest, we absolutely are going to pick different buckets or different holes for strategy, because we don't want to feel like, let's just say, for example, somebody has a lot of preservation tools in their portfolio between bank money, treasuries, annuities, things like that. Could they look at some market money with 10, 15% of their money to take a little bit of risk? Yeah, if they're not spending that money, they're not using it for income strategies, sure, especially if we have a longevity of 10 or 15 years, we can absolutely look at that. We also want to do it as a calculation too. We want to be calculated with how we go about that. So when we have these conversations and we talk about your money and we talk about how you're allocated, yeah, there's a lot of different places to put your money. Let's just say rule of 100, you're 60 years old. 100 minus 60 just tells you that maybe you could look at 40% towards some of the riskier places and 60% towards some of the more preservation areas, right? And we can have that conversation where does that fit you? Or you might have a little bit more of a high appetite for risk or risk tolerance. And this is a discussion, and we want to write this down because we don't want to get this wrong. Well, let's just make sure we still scatter things about and put you in some different places. You know, the L word, Randy, is a key one, liquidity. Mm-hmm. We want to make sure a person always has enough liquidity in retirement. And that's a really important one for me as a financial advisor and as an insurance agent. I look at that and make sure that you have enough liquidity. Then we discuss income provisions. We talk about taxes, and we talk about inflation. Those are really key factors. And yes, to have your money spread about in different places, great. I don't look at it as like when danger hits and things like that, because if you're coming to me for retirement, we're gonna create some preservation tools for you because we believe in them, and we want to make sure that you can put your head on the pillow comfortably at night.
I think the classic example is the person in retirement who sees the market start going down. It goes down 5%, then it goes down 10%. Then he runs to his financial advisor and goes, "Take me to cash, get me out of the way." Yeah, that's the classic situation. Then you say to yourself, okay, you figured out how to get out. Have you figured out when to get back in? And that is a huge question, and very few people can answer that and be correct when it comes to the market going back up again. There are other options out there for you besides go to cash, and let's discuss them. Let's discuss those options with you. You want to get out of the way of the next market crash? Let's show you all of those vehicles. MoreToRetire.com is our website. You can start right there, learn more about Mark and the team. MoreToRetire.com. At the bottom of the page is a place for you to put a little information in there, and Mark will reach out to you. Or you can call 984-300-1984. 984-300-1984. Let's have a conversation about your retirement. Well, this is a pretty good list here. Kiplinger posted the article, The 5 Golden Rules of Retirement Planning. The first one is you got to figure out your L's. They are lifetime income, liquid savings, lowering risk, lowering taxes, and legacy. Mark, I think if you had all that all nailed down, you'd have a pretty good retirement. That almost says it all right there in the first one. What do you think?
That's fantastic. You know, you talk about lifetime income, liquid savings, lowering risk and taxes, and legacy. I mean, that answers the majority of a lot of people's questions, right? Mm-hmm, mm-hmm. So in here, Randy, we were just talking about our motto. When I was a kid and even as an adult, we'd play a game of horse, shooting around the basketball. But here we like to play the shorter game, pig, where you only got 3 letters and knock out people really quick, right? Well, that's what we want to do. We want to knock this plan out so you feel comfortable in retirement. So pig stands for preservation income, and growth. So if we stick to that and we're concentrating on preservation, income, and growth, we're going to answer all of those L questions right there. We're going to answer a lot of those things that you're looking for.
I think that we talk so much about what your paycheck is going to be in retirement. I mean, that is one of the biggest questions that we all want to know. I'm going to get Social Security, and then what? How does that 401k become a paycheck for me? Let's get all that stuff nailed down. And then lowering risk and taxes. I mean, our show basically is all of this in this very first one. So get your L's in line, folks. Lifetime income, liquid savings, lowering risk, lowering taxes, and legacy. Number 2 on the list is use all the asset classes. So where can I put my money? You can put it in the market. You can put it in the bank. You can use the insurance companies. And I'm going to add one in there, too. You could probably use real estate. That could be an asset class as well. Mark, spreading your money around is one thing. Buying 17 mutual funds is one thing, but that's not really spreading out your money amongst asset classes, is it?
No, as a matter of fact, when we run a report, it tells us a lot about how you could actually be investing a large majority towards the Magnificent Seven without realizing it because you have a lot of funds using the same stocks. Mm-hmm. And this can happen. It happens actually quite often. So when we talk about asset classes, the market, banks, insurance companies, well, that answers the question about the 3 things we talked about. Preservation, annuities, we're discussing preservation, right? Mm-hmm, mm-hmm. But annuities could also have growth, right? And annuities could also have income.
Sure.
Okay, so we're talking about that particular class. Then the market. So the market, you're looking at growth and income, mm-hmm. okay? And it just depends on how we allocate. The banks, it could be the 3 as well, preservation, income, and growth too. So again, all of these could be answered under these particular columns. And so what we want to do is we want to give you the right suggestions about how much we want to preserve for you, how much income you might need with regards to taxes and inflation, and then how much do you want to grow? Do you want to leave a legacy like we talked about on the L's?
Third one on the list here of Kiplinger's 5 golden rules of retirement planning is avoid plans that depend on withdrawals. Your assets should generate income. And that actually goes back to our conversation that we had about dividend-paying stocks, is that when you have a stock and you got to sell a stock in order to get money from it, that's really not generating income. The idea of generating income is you put money someplace and it kicks off a paycheck for you. And the only thing that we do now to do that is we exchange our time for a paycheck at work. But we have to make sure that we've got something that kicks off income in retirement.
Certainly. So let's just say, for example, somebody came to me with, let's just say, a $2 million portfolio. Well, if they're only taking about 4% of that money out, which is about $80,000 a year, I get it, but you might want to add in some preservation tools there too as well. Even if you bring in preservation tools, what you're going to do is you're going to feel a little bit more comfortable about how you go about it. So you might want to involve some lifetime income, but then you could also balance that out with simple withdrawals and growth as well. Mm-hmm. So now you're going to that same area. We're hitting the preservation, we're getting the right amount of income, and we're getting some growth at the same time. So do you want to put all your money into an annuity with a lifetime income rider? No, but the balance and the effect of how much money do we want in the market for growth or growth and income, depending on if we use structured notes, how much do we want to have in preservation tools like annuities? And do we want to build in some lifetime income riders into that portfolio as well? This is really important to answer these questions. So I think it's important to avoid the potential for a double whammy, which is if you have all your money in the market goes down, you're relying on withdrawals, and that sequence of numbers, it makes a big difference. We talked about that earlier, so we're definitely going to look for some preservation tools there when you're retired.
Taking money out of a falling market, one of the things that we want to avoid in retirement. Going through this list, the 5 golden rules of retirement planning from Kiplinger. Number 4 is avoid plans that are based on probabilities. You need to account for the what-ifs of retirement. I've seen this all the time. Financial advisor says, here's your plan at 3% growth. And you say, okay. And then here's it at 5% growth. Ooh, that looks better. Here's it at 10% growth. And your eyes get really big. And you go, wow, maybe that'll happen. That's not what they say you should base your success on. It says you should base your success on planning for inflation, planning for tax hikes, planning for market declines, planning for health problems. Get the what ifs out of the way first. That's where you build a successful retirement plan.
Most definitely. What we want to do is make sure that you have enough preservation tools in place to answer those questions. So if you have an answer about how much income is going to come in and you don't have the worry of that, fantastic. Do we have an answer for inflation with regards to that? Well, we better. That's another important one that we want to plan for, and we can do that. Are we going to plan for what if you need some type of long-term care in the future? Well, if you did and you had to go to a facility, or, hey, do you want to buy into one of those places? These are the conversations we have and we discuss because we want to make sure those what ifs are not a concern. We want to throw them in the trash can so you don't have those what ifs. When you go to sleep, you don't count the what ifs till when you go to sleep, because you won't go to sleep. You'll be pulling your hair out. You'll have more hair on the pillow. I already have too much hair on the pillow, okay? But truthfully, we want to get rid of the what ifs. And how do we go about it? We go about it with the three things we mentioned: preservation, income, and growth. And all of those things will be addressed. Inflation will be addressed, taxes will be addressed, and income will be addressed.
Well, the last one on the list is one that we talk about all the time here on the show when we talk about Marc's process. The last one on his process is the ongoing support. Here it says your plan should be adjustable to meet the changes in your life. Things are going to happen to you. It could be a good thing. You discover that perfect condo down in Florida and you want to spend, instead of 2 weeks down there, you want to go 2 months down there. That's a great change. But then there's other changes too, like health changes and things like that we have to account for. It's a pretty good list here. And I think that just following through some of these things can really help out. And it really does go along with what we talk about here on the show all the time. Give Marc a call. Go to our website. Let's start the conversation about your retirement. Let's get your income locked down. What are you going to get paid in retirement? How are you going to get out of it if a market decline takes place? And what are we going to do for growth? We can't just sit there in a 2% CD our whole lives. Give us a call. Here's the number: 984-300-1984. 984-300-1984 or moretoretire.com. We thank you so much for listening. We hope you'll join us again next week here on the Marc Oslar Retirement Experience.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.